people forget and realize that like owning real estate is not actually passive generally, right? Like if you own a rental, like you don't own a passive income stream, right? You own a job.
I think you hit it on the head when you said like, what are you going to do? Work until you die, right? And so I think it's very important to peel off money to reinvest back into your active income.
And so I think like as investors, we oftentimes get distracted by like the easy number, right? You have to say like, okay, well the number's a number, but what am I truly needing out of this, right? And what's my intention and what goal am I? Go back to your financial plan, right? Like what goal am I accomplishing by making this kind of investment? What do I need to get out of it?
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Let's talk storage, dude.
Let's do it, man.
Welcome back, everyone, to another episode of the Telex podcast. So if you're wondering who the heck I'm chatting with already here, it's my my good friend, Big Ben Godfredson.
Thanks for having me on, man.
Yeah, local entrepreneur down here in St. George. Interesting perspective always, like me and you. I was surprised how much we agreed in that little like conversation we were having. We generally have like a lot of different opinions. You've got a unique perspective. You started as an entrepreneur. You're going to Dixie at the time, right?
Right.
Started a moving business. It was like you and one guy, or you
just
yourself?
Me and my buddies, like a pickup truck and a 12-foot trailer is kind of the origins,
Yeah. I think, your original niche was like, helping seniors that were like moving into a living facility, right? Like a retirement home.
Yeah. Even when I was a teenager, preteen, like my grandma managed a rest home and she just like couldn't find a good mover. They were either overpriced or kind of shady.
Yeah.
So she had me and my parents come and I was a stronger kid. So she just had us come move them in and we did it at a good price and they loved it.
Yeah. That's, so you started there. Again, hey, the entrepreneurial spirit, right? In the US, one guy had a couple buddies and a pickup truck, right?
Yep.
Like, and you've grown that into, a pretty decent sized moving company, like, well done. First off, I just, from an outside perspective, right? Like, man, your trucks are around town. People certainly know who you are. You've got a presence across not just Southern Utah, but up in like Provo and Salt Lake. I know I've had you move stuff for me personally, like across the country. And so you guys got, what are you running now? Like 6-7 trucks, or?
We just bought our eighth
truck.
Yeah.
Yeah. So like, so you grew something from, hey, self-employed to a business, right? And I think that's like a really important thing that a lot of people in the entrepreneur life cycle don't appreciate. It's going from self-employed to, business owner to at some point investor, right?
Right.
And, it's been fun to like watch the development as we've been friends. But a couple of years ago, you started working with storage, and correct me if I'm wrong on any of this, but your first storage unit was your own storage unit, right? It was like a value add to your business, your storage business, your moving business. You had this, if I'm recalling kind of the story right here.
Yeah.
You're like, hey, it would be just a great use of capital to leverage an SBA loan on a commercial property that we could fill with our own moving customers, and get that business funding, at a favorable rate, that kind of stuff. And so you built a storage facility here in St. George.
Yep.
Right?
That first facility, we were just getting so many calls, people saying, hey, I've heard you're a great mover. Can you move us? Of course. And can you store our stuff? No, I'll have to pass you off. So we had like really good data on the demand and lead generation.
Yeah.
And the whole time I was doing the real estate model with frat houses, just filling up a 3-story house with 9 guys. So I got to see a refi and the cash on cash and the tax benefits and kind of see, okay, here's my training lesson on real estate. And then I put my life savings in that first facility.
Yeah. That played out well, and it turned you on, I think, to storage in general, right? And so now you're running a number of storage facilities. You've got a whole business model where you come in and you can take over an existing storage facility and, plop your guys' management on it, right? And kind of do it that way. I know you've built some more facilities, all this stuff. What I want to really get into is, I think probably a shorter part of the conversation initially, like what's the use case for storage as an investment, right? Like what are the kind of pros and cons? But then, hey, what are the lessons learned as a real estate investor that started with single family, right? Which like so many people think is like the thing, right?
Right.
And you've made this pivot to a commercial style, operation. And, what do you give up doing that? And what are the benefits, right? And what are the lessons you've learned along the way in that?
Yeah. Well, first, like where would this be good in someone's portfolio? I think the three main things we look at in storage versus other investments. Obviously, you have the depreciation. We had one individual in town who made an exit on his business, had a huge tax burden, and so he just gobbled up 3 facilities with us in December of last year, just kind of as a buzzer beater to save on taxes. So that's like one of the main ways. The next way is the cash on cash. We give quarterly dividends and reports, making it a little more passive. When you compare it to residential, a lot of times your margin is either you have to be the property manager yourself or delegate it out. So that can eat into your cash on cash a lot, where I think with commercial, there's a little bit more meat on the bone. There's a little bit more to go around. So you have room for syndications and stuff like that. And then of course the long-term equity appreciation, creating, cap rates are better on commercial properties than your single family homes.
So what is it that you like about storage in particular as a asset class? Like what has been the most exciting things to you about the asset class?
Well, I think for me, it has the benefits and good characteristics of a business and real estate, right? So all those things I just described that are real estate things, but a lot more that you can do to control, like marketing comes into play. Like if you have a rental property, you fill it once, you have, a price range of what you're hoping to get, but there's an actual marketing strategy, generating leads, running ads, the sales piece, having a clean operation, So you have all these benefits of driving revenue that you have in a business, but all the mechanics of a real estate investment too.
Yeah. I find it really interesting. People forget and realize that like owning real estate is not actually passive generally, right? Like, you own, like if you own a rental, like you don't own a passive income stream, right? You own a job, in some regard. It's like it's work. Now you don't have to be a marketing expert to get a tenant in your rental, but what you take in exchange for that is like a dispersion of outcomes, right? So like, hey, whether you get 2,000 or 1,800 for your rents makes a huge impact on your, return, your cash flow, your cost of carry, or your carry, or what you get paid for carry, right? And the difference could just be you finding the right person, or marketing well, or having access to really good and clean data, right? Or sometimes it might just be in the Lord's hand. You get lucky, right? Like, right. But you kind of get it. Like if you have one property, it's sort of like all right or all wrong, kind of thing. And so dispersion can be really favorable potentially, but can also be, and I think more commonly, especially for owner operators, it can be really unfavorable pretty quick. Whereas storage, if you have, I don't know, what's the average number of units you have in a facility, right?
Yeah, a couple hundred at least.
It's like, if you like price one wrong or price 50 of them wrong and they fill up and you kind of got an obligation to serve at that rate, then like, well, you can still go get it right with the other, 250, right? And so your dispersion can kind of tighten up and smooth out. I think that's really just an illustration probably of like the law of large numbers sort of idea. But there's some edge in that I find interesting from kind of trying to smooth things out.
To your point, like you can split test promotions, right? Like if you have trouble leasing up a third story unit, it's like, okay, let's split test how many months do we need to give away? Is it buy one, get 3? Let's see what performs the best when we run the ads.
Yeah.
And same thing on rent increases. If you find a facility that's under market on rents and you're just looking to get them up to market, it's like, okay, let's raise a third of them up to market. And if we get no response, no one moves out, like maybe someone calls, but by and large, they all stay. Maybe we get more aggressive on the second third. And then maybe that one that a couple people do move out. So on the last third, we go back to somewhere in the middle, So you have way more data that you can use to drive revenue.
Yeah. What's the downside to storage? Like, what have you found it's an asset class that you're really excited about. You get the business operating benefits. You still get a lot of the real estate benefits, the depreciation, the cash flow, the use of, government subsidized leverage, all these things. But what are the drawbacks?
Yeah, I would say the first one that comes to mind is liquidity, right? Like I tell people before they're going to sign up for this investment, like, yeah, it's very likely that if you get in a pickle and you need this money back out, like it's very likely I could get you what you put into it. Mm-hmm. But anything on top of that, you kind of need to wait till the business goes full cycle, right? This is not Bitcoin. This is not a get rich quick thing. This is a long-term investment, commercial real estate. So I tell people, first, make sure that you have enough for your active business. Like you should only be investing in commercial real estate, the surplus you have, right? Like even my business, like a moving truck, I'm paying $145,000 for a new moving truck now, mm-hmm. but I can still get that return pretty fast, less than a year I can pay for it. Mm-hmm. Where storage, it's way more passive, but you're going to invest in your active income first. Make sure you have a emergency rainy day fund. Anything you need liquid, keep that in something else. And then anything that you're just like the long term, that's probably the biggest thing that when people ask about like the drawback, that's probably the first thing that comes to mind.
It's interesting. It reminded me really quick of the book, Profit First. Mm-hmm. And this idea that entrepreneurs always like, we have this tendency to always like reinvest in our business because like, of course you get a great return on investments. Like you're active in it. Yeah. Right? It's like very active, it's like, I wouldn't want to reinvest money in my business and be like, I can get a 10% rate of return. Like, why would I put in any kind of work if you can get sort of that in a passive, ETF or something, right? It's like, makes no sense. So like if I invest money back into my business, I want to double it, triple it, quadruple it in a year, right? Like, and when you're operating a business, like you can put up those insane type returns. But what sometimes entrepreneurs then fail to do, it creates a knock-on effect, right? Where we subconsciously make that our hurdle rate. Like, why would I invest money anywhere else? Yeah. I could invest it somewhere else for 10, 15%. And I put it in my business and I get a 4x it, it's like, okay, just like, hear me out. What are you going to do? Like just work till you die? Like you infinitely grow it. What if your business goes wrong? Like what if there's a regulatory constraint or you get sued or like whatever? What are you doing outside of your business to help build your personal net worth and have your business be one asset on your balance sheet, right? That typically is like, you can, put some money in, get a great return, increase cash flows, and then use that to support your empire building, so to speak, right? On the rest of your balance sheet. And I think that's what you're describing, right? Is like, you can buy a moving truck and you can hire another crew and, you get this pretty quick return on the whole thing. You at least get your money back and now you're getting the passive income off of that. But like, you're also taking a lot more risk, right? If a recession comes in and people stop hiring movers and they move themselves, like it's kind of that like, hey, 4x or go to 0 sort of thing.
Sure.
And probably not exactly on a truck, but that's the sort of risk profile, right? A lot of times when we invest in our own business, right? I know I've made a lot of investments in my own business where you have an idea or you try to implement something, you spend, whether it's an investment of time or capital, right? It's like, it works out really well, or it was like a complete waste of time and money, right? Whereas, if you have assets that are on your balance sheet that aren't your business, right? Again, it's that dispersion of returns tightening, right? Storage, I think compared to a lot of things, can have a pretty exciting return in context.
Yeah.
But certainly a totally different asset than, starting a a business selling widgets on Amazon, right? Like,
right.
And so the investment profile is just totally different.
I think you hit it on the head when you said, like, what are you going to do? Work until you die, right? And so I think it's very important to peel off money to reinvest back into your active income. But yeah, like most of the people that are putting money into our storage deals, because every deal, has been open to people to come invest in, they have their active business, whether they're an executive at a company, a doctor, a lawyer, even if they're just someone who wants to drain their other investments to put it into commercial real estate.
Yeah.
I think that's kind of been our profile. And so I think, you got to have both, but storage is very good at being counter cyclical. Like when you have these higher risk things that could get shut down fast, like it's done really well through 2008 crash, through COVID, it did really good. So these uncertain times, it's stood the test of time.
What do you think the headwind from the interest rate environment could be to storage as an asset class in general?
Well, I can maybe related to that, I could tell you like what I've seen since I've been in the game. So my first deal, I caught the tail end of I'll call it a boom, right? So I built the facility 2019, 2020, 2021. I caught it, right? And so learned a lot of lessons. The next facility we did, I was pumped, right? We were doing really well. I was watching YouTube videos from my mentor, AJ Osborne.
Yeah.
He was converting Kmarts into storage. So we bought these 2 warehouses up in Provo, and we had this plan this is 2022 now, and we had this plan to build 100,000 plus square feet in Provo. And the bank gave us a loan for $10 million. And then we started we have the full set of plans, but we realized that we were at the top and we were going down.
Yeah.
Demand was going down, things were shrinking. So we had to basically cut the project in half, keep one of the 2 warehouses and rent it out to commercial tenants, and only build half the storage. And we basically told the bank, hey, cut our loan in half. We're not going to use it.
Yeah.
So we've been buying and building all the way down. I feel like the market is, I don't know if we're almost to the bottom or if we've hit the bottom and we're about to go back up, but I do know as far as supply of storage goes, we're watching the supply numbers and they're shrinking. So when all the boom times were happening in 2021, people started printing money doing storage, they started building, and it was getting more and more. 22, 23, 24, people had to finish up those projects.
Yeah.
But finally in 25, 26, we're watching people stop building, which is good because finally the supply is so much higher than demand. It gives them a chance for the demand to start to cash the supply again.
Interesting. What do you think the risk is for the asset class? Like a lot of times in storage, people highlight the pro as like counter-cyclical, recession-proof. I'm always I'm skeptical on a lot of stuff from like long-term cycles perspective, right? Because it's so easy to say last 20 years, storage has done great in every little blip. Well, okay, that's like the last 20 years, but it really wasn't an asset class that, you can look back and say, well, how did it do, in the 1600s? Right? Like you can study like markets and interest rates and this sort of stuff. Like it might not be on the New York Stock Exchange, but you can really study this stuff through like, big economic cycles throughout world history. And storage is like a relatively young asset class in that perspective, right? Like, and so recency bias certainly tells us like it's counter-cyclical, but what about like a demographic shift or a cultural shift in general, right? So like something that came to my mind is like there's that popular Netflix series, I think it's on Netflix, with Marie Kondo, like the simplified lifestyle, like clean out your space, have less stuff, just like let go of things, like be, and you're seeing more people go from like, hey, I want to have a big home to like, hey, we're going to live somewhat of a nomadic lifestyle and like live in a trailer with my kids and travel the country. And, like fork off of that is like, does that mean they get rid of their stuff or does that mean they actually are now a long-term storage customer, right? Like, I don't, but is there a potential risk to storage? There's all this supply And there's all these boomers out there that
I was going to bring that up.
Have like houses full of stuff that, you know, like they move into care facilities or they've like loaded stuff up and, you know, as kids inherited. I mean, like, look, candidly, when my grandparents died, like, they had lived in the same house since my dad was 4 years old. And I think it took a 40-foot dumpster, you know, just after you took, you know what I mean? After you took out all the stuff that's, you know, reasonable or, you know, memorable or this kind of
sentimental
stuff.
Or useful.
Yeah, right. Yeah. I'm just stuff, right? That you're just like, that is just it's just old. I mean, you know, I love my grandparents to absolute death, but like junk, right? Like it's just,
I get it.
We all got it, right? It's like, and so at what point is there a headwind from people saying, hey, you know, mom and dad had this storage unit, but we're just going to go clean it out or just default on it or whatever, because like, it's just a bunch of junk in there. We don't want to, like, we just want this underlying cultural shift of just less stuff, right? Like, is that a headwind for storage potentially?
Well, I think about this and I honestly feel a little bit like a drug dealer because I don't get high in my own supply. I look at what people store in these units and I'm like, I feel like I'm selling them meth. Like, why would you pay money to store this stuff in my facility? Like, I would never store this stuff in my facility. But then I think about the times that I've moved. So like when I moved, then I did store my stuff in my facility. You know what I mean? It's like, I think, that's what I see the demographic point. And it's like boomers, they collected stuff because they have the Great Depression, right? And we would, you know, you would think that people would be less and less into consuming and buying stuff and hanging on to stuff. But I think the biggest thing that makes me have faith in storage is the fact that while that whole like boomer attitude of like hoarding stuff is dropping, the data for people moving and moving more often, like those boomers also used to stay in one place their whole life. Yeah. Now the new generation is like, shoot, I'll jump ship and take a job offer somewhere else. I'll go explore a new state. I have no roots to my hometown. So I think there's other data points where that is a threat, seeing the old generation die off and like their behaviors leave. But now you have new generation that's like, shoot, I'll just put myself in a storage unit and go be a wanderlust blogger for a while, you know? So I think it's a threat. It's something to monitor. But I think as the moving behaviors tick up, they kind of balance the consumptionism and hoarding that's going to decline.
Okay. It's an interesting perspective.
Yeah.
I guess just something to monitor.
But I get it. I don't think I would store some of the stuff that my customers store.
Well, I sort of think of it like probably a lot of the people that are using what you're describing, like for lack of better terms, like the new age use of storage, right? Or the thing that we're saying like, hey, this could be a positive to storage is more of like a temporary storage situation that's maybe a little bit more intentional and thought out versus like the old situation of like, you're banking on that person to fill us up with like all their, it's going to look like a garage sale stuffed into a storage unit. And, you know, you're hoping they just pay the bill every month for 15 years, or 20 years. And, you know, cause they don't want to like lose their stuff, even though, you know, you tally it up and you're like, you're paying $200 a month to store $100 worth of stuff you could donate to DI.
It's true. Let me just speak to that real quick. So we call those core occupants versus transient occupants. Now a core occupant is someone who, and we study this stuff, sorry if it's boring, but they're a core occupant, someone who calls every facility in town because in their mind, they just need an extension of their garage. They're going to keep it till they die. So they're going to shop. They're going to be really price sensitive and, you know, they're going to behave thinking that they're going to keep it long-term. A transient occupant is someone who's like, I'm only going to keep it for a couple months or just for a short amount of time. And the transient occupants are more likely to buy and rent from the first person they call and pay more because they think it's a short-term thing. And we can acquire those core occupants and raise their rent later, and we can acquire the transient occupants and they think they're only going to stay for a couple months, but they end up staying for a lot longer than they think.
Yeah.
They have a different
mentality,
psychology going into the storage experience.
I think that ties back into the expertise of running the business. that side versus just, like, yeah, buy a facility, plop somebody in the office and, put your price on the website or whatever, help people sign up. I think that's a really good demonstration of the management
Can I just
side.
speak to that? Like we have, I won't say names, but we have facilities in town. Basically, they both built the same triple decker facility. One is managed by Extra Space, who's publicly traded. They know how that game works. They know customer psychology. One's managed by someone who's just a local person who just wanted to park some money in storage. And their occupancies, like Extra Space is full. This one that's been open even longer, they're still struggling because they don't understand that piece.
Yeah. Yeah. I think that it just speaks really well to, the asset of the business is real estate, but it's still a business, right? If you don't have a business tied to real estate, it's largely speculation, right? Like, because even if you're like, well, it's farmland, your business is farming crops, right?
Yeah.
Like maybe you get some, tax advantages, you get, preferred lending, right? Programs or this sort of thing, but it's because you're running a business, right? If you just own a bunch of farm fields and do nothing with it, and you're, I'm using air quotes, investing in that, you're speculating that the price goes up in the future, right? Like, what driver of demand are you expecting? Now, speculating isn't inherently a bad thing. I think like there's intentional speculating where you think you have some like inside information, and not, like, don't speculate on stocks if you have inside information. Okay. Like that's not speculating. That's insider trading. Don't condone that. But like, if you own a piece of property and there's,
new Costco coming in.
New Costco to come into town, or like you think you can get it rezoned after the city council election shakes out the way that you think it's going to work out, right? Like we saw that in St. George last couple of years, that sort of thing. And like, okay, so you have some maybe not inside information, but edge, right?
Yeah.
Like you would say edge is probably the right term. So you have some edge, you want to speculate on that, right? You can make that an investment, but oftentimes people in real estate, you're really looking at, okay, I want to own this because, and like, what's the number one thing I always talk about is like cash flow. And they say it in passive income. It's not passive income.
Yeah.
But like, what they want is a productive asset, right? Because the reality is like the only difference between owning storage and owning, Walmart is it's a different business model, but like, storage is going to get preferred lending treatment and depreciation and all this kind of stuff. And then, fills it up with occupants, i.e. customers, produces business revenue, pays out the revenue as, dividends, right? And Walmart does the exact same thing, right? They got a big quasi warehouse, they have the real estate. And if you think Walmart's not depreciating those assets and taking tax advantages, you're crazy.
Yeah.
And if you think they don't get like good lending terms, you're crazy.
Yeah.
And then they have, customers that come there, spend money, they run a business out of that. And, they run all their tax plays and they pay you out a dividend for having ownership. Right. So it's just that there's two just totally different businesses ported on top of real estate. I mean, like McDonald's is another like pretty good example of something that's like a real estate focused business that just runs a business. And the whole idea is like, you want to own that real asset underlying everything, but you need to have the business activity on top that gives you that positive carry, that cash flow. And that's that really is the intentional benefit, is like, it's never just speculate on like real estate. I mean, not never, but it's usually not like speculate on real estate. It's like, hey, I've got, some cash or equity I got to roll or whatever. And where can I park it that I get, I own equity in an asset that they can't just, like print more of, hopefully. That makes it like a real asset. And it's why they call it real estate. And what can I get back out, on that cash, right? What can I get returned to me from the business operations? That's your cash flow. And that's like, but without it, real estate's pretty underwhelming. And without it, candidly, like my base case is it's going to be very underwhelming for a period of time because of the interest rate environment. I think recency bias tells us that, hey, in real estate, you can accept these low cash flow numbers, right? But it's okay because you just get paid a little bit every month, but then the property is going to appreciate, and so, man, in 15 years or, in 20 years, you're going to have paid it off and, it's going to be worth all this crazy money. And the reality is like, it's pretty lofty. It's like, honestly, like pretty crazy assumptions to look at where we're at in the cycle. At least this is my opinion, and say, hey, real estate's done so well the last 15 years. So we're going to project doing just amazing over the next 15. It's like, oh man, that is historically a really bad idea. When valuations are stretched to say, oh, we'll just keep having these boom years. And so if you want to actually normalize out what real estate returns sort of look like, you really would want to project out probably the next 15 years having a very meager capital appreciation on real estate properties. And it's probably the time to focus super heavily on the cash flow side, right? Because you're not going to have your poor choices really covered up by, the equity appreciation, right? Like I can't even tell you, Ben, how many times I've looked at deals with people that they were actually, that they were either looking at or had already bought and owned, and I'm like, you're losing money on this deal. Like you would be losing money every single month, they're like, no, I get like, it's like cash flow $300. I'm like, yeah, until you like factor in vacancy collection,
your property tax.
Yeah. It's like, until you factor in like a couple, like, you know what I mean? It's like expenses that you're not anticipating. And then you're like, you're going to be net loss, and their answer is almost always like, yeah, but it's going to go up. It's like you get like so much over time. It's going to be worth so much and the property paid off some point. It's like, yeah, but you can run that out over a course of time actually and say like, yeah, so you end up with like a property. And so over 30 years, we think you're going to buy property at X, it's going to be worth Y. And your cash flow, even assuming like just no net cash flow, right? Just it comes in just enough to cover all the costs and pay the loan off. And so you just get the equity from paying the loan down, right?
Yeah.
You just go like, hey, so the cash you put into that deal, right, to get it, and then you run that forward like 30 years, and you're like, you at this point look like you might do better in money market accounts, right?
Yeah.
Right? It's like, and people are so shocked at that, but it's like you have to understand how upside down the numbers are in a lot of real estate deals right now. And people are just twisting models to make it like look favorable. Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you. If you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you. What do you think is different about storage? And what lessons have you learned that would lead you to think that storage is maybe different or has a different edge than a lot of like, the residential type space?
Well, first thing I'll say is I think having a team that is very conservative matters, right? So like I am the visionary, I'm very bullish, I'm very optimistic. And so I've hired and brought in partners that are very conservative, almost like the opposite, right? So when we're underwriting our deals, like even the one that we reviewed the other day, we're projecting like a net 2, net 3% increase year over year. When we factor in the expenses, the property tax, all of that increasing over time as well, right? And so my team's really good at helping us use really good investing fundamentals.
Yeah.
So I feel like that's one thing you got to have when you're looking at real estate, no matter what. Now, I think
I just want to clarify like really quick for like the compliance perspective. That's not your like return assumptions. That's not like what you're anticipating returns to be. You're saying like that's what you think you can grow the top line revenue from like a business planning perspective.
Yeah, the revenue growth. Yeah.
Okay. Cool.
So back to what I was saying. Basically, I think you're going to target why you want storage specifically is one, the consolidation. So we feel like we're in a golden age where you look at something like apartment buildings or hotels or something, where 90% are consolidated with the big guys and 10% are mom and pops. Like how many skyrise apartment buildings are owned by like one family or a mom and pop, right?
Yeah.
Storage is in its consolidation era where it's going from 50% is consolidated to 50% is mom and pop. So if we can get in now, it's going to get more and more consolidated over time. We're just in a position where that consolidation piece helps us ride the wave of this asset class. Mm-hmm. So like you said, it is a newer, relatively to like hotels and apartments, newer asset class, but that's good because it's still being consolidated. So I do like that piece of it. I also think it's very tangible, like compared to investing in like Nike, right? Like Nike, I saw Nike took a dive, right? It's like, how much control do you have over Nike? Can you go to Nike headquarters and visit them? No, but you could come see this facility. Like we're giving tours of these facilities and kind of like helping people see the vision when we're looking at it.
Yeah. So I got to interject on that one. And the reality is it reminded me of this quote, like, if you don't have a seat at the table, it's because you're the lunch. And so the reality is like, if you're, like the beauty of publicly traded companies is anyone can go on and buy, anyone can go buy Nike stock in the US. Right.
Yeah.
But
that's a good quote.
If you have enough, there is, like look up what activist hedge funds are, right? There is activist investors, right? They do acquire a 10, 15% stake in a company such as, Nike potentially. And they walk in and they talk to the board and say, you're going to do things different, right? Like I own enough of this. I'm gonna throw some weight around and you guys are going to take me serious. Right. And I've got an opinion on how the business should be run here. Right. It's, some people call it like buying a seat at the board, whatever. Right. But effectively all you're saying is, hey, in a smaller storage deal, you have the opportunity to be that, whatever, 10 or 15 or 20% investor. And so it's really not that like, it's just that you're a bigger fish in a smaller pond, so to speak. Right. And so, I guess what you're saying the edge is like, you don't have any controllability if you own 0.0000001% of Walmart. Right. But if you own 15% of a storage deal as a partner, you can talk to your partners and say, hey, I think we should handle this differently. And, and maybe the majority partners still, you don't really, and what I want to highlight is like, you don't actually have the control, right?
Sure.
But you've got a seat at the table. And that is inherently different than maybe just, obviously being a shareholder in a ETF or a mutual fund that's a larger capacity, right? I think about the difference. A lot of people forget that like you can go invest in storage or commercial real estate, like incredibly easy in the US. It's just publicly traded REITs.
Yeah.
Right.
Extra Space has a stock.
Yeah. It's like, go invest. And the reality is like the net economics, like it's all the same, in terms of like operation. Right. So like if you have the ability to go buy a storage unit and then run a business on top, like a company like Extra Space, like they've got the ability to go build or buy a storage unit and run a business on top, right? It's the exact same thing. Now the entity structure might allow for a little bit different treatment on, how you get in or out of ownership, how you technically get paid out. But the reality is like what you get passed through on income and maybe it's a K1 on a private opportunity with storage, you get paid out, dividends and get a 1099 from Extra Space. But where those all net out, like net of taxes, is going to be in the same ballpark, right? It's not that like and I guess what I'm highlighting is like, if you look at Extra Space and you're like, I would never, right? Like you're like, I would never put money in a publicly traded REIT ever in my life. It would just be the worst investment ever. Then like, the reality is like, you're probably not going to be that excited about doing any kind of private real estate deal because the numbers and the fundamentals are not that different. But there can be some edge when you have this like seat at the table and you say, hey, so like we can do better now. Like there's trade-offs, right? So like you want to own a publicly traded REIT, instant liquidity, right?
Mm-hmm.
Get in and out, simplified tax reporting, right? But like that comes with some drawbacks. You don't have a seat at the table and you got no say. It's thousands of units or, locations, whatever, right? Like you don't really know exactly what's going on. So it's super macro. You're a nobody. And then also sometimes, and I think as smaller entrepreneurs, we would share this common belief is like the big guys can't get out of their own way sometimes, right? Like, and so what you want to look for is when you're making these smaller private deals is like, there's edge that you can try to take advantage of, right? As a smaller operator. And the reality is like, if, these big guys, a lot of times these smaller deals, they're not nimble enough to take care of it. And I think like this is where a lot of private equity funds do well is they're like this initial private equity fund where they're the initial, big investors into a small company. And then they scale up operations, they maybe clean it up and for lack of better terms, legitimize it, whatever. Right. Mm-hmm. And then over a couple of years, they look to flip it to the guys that are like going to pay way more because they just needed a prettier packaged product. And so all of a sudden that's what creates the opportunity between like, well, do I get a public REIT or do I get, a private investment opportunity or do I do a combination of both or what's that mix? It's like, there is differences in reality, but it has to do with the operators and the type of deals that you choose to invest with.
Well, and that spread is exactly what we're doing, right? We're buying deals at a 9 cap that are from a mom and pop that doesn't have a website or they don't know how to run the business, legitimizing them and then trying to sell them for 6.5 cap to a regional player. You know what I mean? So I think you said seat at the table. I think that's a big one. And I think that's something that we provide. I think another thing is also a peek behind the curtain, right? Like, can you sit down with Extra Space and look at their spreadsheet, say, here's the rent roll, here's what, like on this one facility, here's what they're charging, here's what everyone else in the market is charging, and it's $100 more. You know what I mean? And so you show the spreads. I think the seat at the table is a big deal, but also the ability to go say, here's the units that are under market, here's the units that are empty, here's like the full business plan.
I think you underappreciate, like if you buy enough of one of the big guys to have a seat at the table, you'll have those conversations. I'm almost sure like you'll see.
But how much does that cost? And do you need a group to do that?
Well, that's my point, right? It's like, you're not talking about, putting $200,000 into, a publicly traded company and getting a seat at the table. You're still like not even a rounding error yet. Right. Yeah. Like, but if you got $2 billion to put into a $10 billion company, like you're going to have a seat at the table and they're going to show you the spreadsheets. Yeah. You're going to be on the board. You know what I mean? Like, so you can still buy a seat at the table. Just what I'm highlighting is like, it's unrealistic for anyone listening to this podcast probably to like think they'll get a seat at the table, in those opportunities. And I think that's where people, sometimes they have the interest in like, oh, well, it's something that I've got some control over. And that's where I'm trying to like remind people. It's like, there's a difference between like access and control. And the reality is like, unless it's 51%, you don't have control. Yeah. And even at that, like you still can only control what you can control. So even when people are like, well, I like investing in residential real estate, so they're 100% owner, and they go, cause I can control it. I'm like, you can't, like you can only control your controllables still. You can't like magically say, well, I'm going to raise rents next year. It's like the market still has market forces. Like you can't say, well, I bought it for $350 and in 5 years I'm going to sell it for $400. Like my friends out there, like if the market is going to give you $300 5 years from now, like that's what it's worth. You can't, just because you can touch it and feel it doesn't mean you can control it. Right. And so it's very naive for any investor to think that they can control the market, right, in any capacity. And so having a seat at the table, having access, having your opinion be valued, right? Hey, having a deeper look at the fundamentals, right? Getting a little bit more access to information. Those are all valuable things. But the reality is like, you still can't control much, and certainly you control way less if you're a minority partner.
Yeah. I think the last thing I'll say on this, like comparing us to Extra Space is like Extra Space is going to buy way more. They're not going to touch anything that's not pretty much class A, or at least like really close to class A, sure. Where we're getting deals. Like we got a deal, New Harmony and Cedar, 2 facilities, 5% down, 2% interest rate, like because it's a small deal. And I pretty dang sure that those returns on that deal beat what Extra Space is going to put out in a stock. Mm-hmm. It's a little bit more risky because it's a tertiary market. Yeah. It's not something Extra Space would ever look at.
Yeah.
So you have your trade-offs.
That's what I'm saying. And that's what I'm highlighting is like the fundamentals of the business are the same, but you have to dig deeper and say like, but what do I want to invest in really as like the subcategories here? It's really maybe putting a little bit different. If you look at like the bond universe, right? It's like, well, you can get a 20-year bond issued from the United States Treasury, and you can get a 20-year bond issued from Apple, and which is totally investment grade. And then you can get a 20-year bond issued by like Zoom or something. You know what I mean? Like some small tech company, right? It's like, and those are wildly different investments. And so what you just end up with is the problem that markets have is like the bigger the shop is, the bigger market they have to look at because it has to be able to absorb the capital, right? So like I've had a number of friends that used to work at big shops, like maybe like Vanguard, and they'd say like, oh yeah, we had this idea of like totally confident you could beat the market in, like this small cap international or whatever. Like we had this great idea, and then it gets immediately shot down because they're like, hey, on day one, it's going to get seeded because, we're whatever big box shop, it's going to get seeded with $20 billion of capital. It blows out the whole market. You get a huge run up, and then we have to gate the fund and the whole thing. You know what I mean? Like, so you have to go to like market cap weighted because it's the only thing that can absorb the capital for these big shops to like. And that's why you have right now this dominant narrative in markets saying like, just, buy the indexes, buy and hold, stay, you know what I mean? Like, it's because you can't have a lot of capital moving around with how inelastic stuff is and how much money is actually out in the markets right now. And so what you're highlighting is, hey, we just have the ability to be nimble because we don't have to deploy $10 billion. Right. Yeah. And so we can be the guy that goes out and says, hey, we don't have to stick to, treasuries and figuring out which spot on the yield is the best to optimize. And maybe like the biggest issues of, high quality corporates from these massive companies that issued massive debts. We can go look in the junk bin, so to speak. We can go look in the bargain basement, right? Where, hey, it doesn't make sense for these guys that manage literally trillions of dollars to be like, hey, the entire issue of that bond is $100 million. Like that's a rounding error, right? Like what are they going to do? Buy the whole thing? It's like, and, whereas a smaller operator can, right? And that's always been the small, the advantage from a size factor perspective of small, right? Is like, that's what you're supposed to be able to get, is that nimbleness, that depth of expertise in a certain area. But fundamentals of bonds are the same on, a high yield bond versus a investment grade corporate, right? It's like they're both issued by companies that have business revenues, and they pay coupons and interest and give you your money back at a defined point in time, and there's terminal math to it. But there's a big opportunity to say, where do you want to focus your investment, or what fits better in your portfolio, or maybe it's a combination of both, but to what extent, or to what purpose, or what liability are you trying to line that up with? Right.
Yeah.
I know, I think that probably beats a dead horse.
No, that makes sense.
I think the last thing that I want to really highlight and just talk about for people that, again, they just don't, I find people don't appreciate this enough, is, what I'll find people doing is they will say, well, on my rental, I get $2,000 a month in rent. Right. And I looked at, somebody pitched me this, whatever, real estate, commercial, industrial, whatever, storage, whatever. Right. And it really, I'm doing so much better with my residential because they were only going to give me like, $1,500 a month cash flow was the projected cash flow. It's like, well, hold on. It's like, you're missing a huge component here, right? Is like, in one, you get $1,500 shows up every month, right? Theoretically, certainly not guaranteed. But it's like, it's a bit more, it is really a lot closer to truly passive, right?
Right.
There's a whole management team and a whole business operating. It is more like being an owner in a business, right? And just getting a dividend from a stock. In this case, a lot of times it's maybe a private, fund or a private partnership or whatever it might be from a structure perspective. But like you get a mailbox check and you get a tax from at the end of the year, right?
Yep.
And they're probably not asking a whole lot of you in between. Whereas like, if you own that property and you're getting 2,000 on rent, it's like, well, you got to remember, you got to take out your taxes, right? You got to take out the, HOA expense. You got to take out your projected costs on your vacancy turnover, right? So if every year you turn over a tenant and there's like a 1 month gap, like you're not actually making 2,000 a month. You're immediately making, you just went from 24,000 a year to 22,000 a year. So that knocks off what, $160 a month roughly.
Yeah.
So you're already closing gaps. And then, it's like you're carrying the risk of the roof going bad or the place burning down, or, like what happens when the place burns down? You don't get compensated for lost rents. Typically, it's like you just, so there's all these things that you potentially have to deal with, all this risk liability, right? Somebody falls and, breaks their neck on your rental property that you own. Like you've got liability issues. Somebody slips and falls in a property you're a limited partner of, like you're a limited partner, like, right? There's a different liability treatment potentially. And again, like a storage, you invest in something like storage as just an example. Like you're not going to get the call in the middle of the night, like the furnace is out or the water heater's not working or the toilet blew up or whatever, right?
Yeah.
Like you own rental properties, you have that. And then, the last thing I'm going to say on all that, because sometimes the smart people out there are listening right now and they say, well, like, duh, dude, that's why you hire a property manager. I go, yeah, but there you go. That's 10% probably coming out right there. Right. So all of a sudden you're like, hey, you're pretty close to the same net numbers oftentimes on these deals. And it's just, one is a little considerably more passive. Now, again, you give up some of that control. You might have a seat at the table still, right? You might have some access. You're giving up definitely the control, but like one's a job and one's an investment. You just got to make up your mind, and if the only thing you get is I retain control, but I retain a job, is like, you got to be honest with yourself. Is that what you really want?
Right. No, I think you're right. I think looking at it apples to apples is something that a lot of people have a hard time when they're looking at residential, right? And factoring in, like you hear Brandon Turner, he's like, I'd go down to every little line item of how much money. And some of these properties, they're not cash flowing that much because I'm factoring the 7-year roof replacement. I know that I got to replace the floors in 10 years, right? So I think you have a great point there. And I think this truly is something that when you have a team that insulates you from the actual tenant and just gives you a quarterly report and quarterly dividend, that's what makes it really attractive. I think, on a lot of these, this would be a no-brainer if we get to stabilization. I think a lot of people would see that. Why would I not do this? I think the only tough thing is the entry point on commercial real estate is sometimes more competitive, right? So a lot of times that entry point, you got to lease up or flip the business. It takes a year. So like on the, just for an exercise, right? Like if I'm truly netting like $1,400 a month on my rental property, and maybe the first year a month, maybe the first year the cash flow would only be 1,000, right? That's $400 less a month for that year. But then in year 2, it's going to jump to 1,600. It's like, can you stomach that first year of a couple $100 less for total passivity? Yeah. So we see people a lot of times in that predicament, where by year 2, you're making more money and you're not taking a call. You're not having to do all of those things that you listed.
Yeah. And it takes maybe a couple of years to break even on that initial drop in cash flow. But, I think especially for people trying to put together retirement plans, that you just have to think through things fully as an investor, right? I think that's really the name of the game, and you have to appreciate that there's pros and cons to all of these things, right? And I certainly don't want to mislead anyone here by like them thinking like, oh, Brandon said everyone should invest their money in storage, right? Like I don't think that. I don't think
he did say that.
Just kidding. No, I don't think it's for everyone. I don't think anything's for everyone, right? Like. But certainly if you're interested in those type of investments, right, or you have a need and you're trying to determine what kind of final investments, right, like you just have to think through all the pros and cons of different investments. And a lot of times it's like not intuitive, right? We just, when I'm talking to financial advisors, I always joke like most financial advisors have no idea how to build a portfolio. They just look at the last fact sheet and just put it in front of somebody and say, this fund has done great the last 10 years. So here's our expected forward-looking return. And they're not super off base, by the way. That's literally how they taught that's how they were teaching kids in the master's program at Utah Valley doing CFPs.
Yeah.
And it's like, oh my gosh, that is so intellectually deficient. But that's the reality. And so like as investors, we oftentimes get distracted by like the easy number, right? And you have to say like, okay, well, the number is a number, but what am I truly needing out of this, right? And what's my intention and what goal am I, go back to your financial plan, right? Like what goal am I accomplishing by making this kind of investment? What do I need to get out of it? Does this align with my values? Does it help me achieve a goal? Does it help me free up time? Like what does this help me do? And you ask those questions and it helps add a lot of context to like whether or not the numbers are good, right? A question a lot of times people ask me is like, well, is that good? I'll say like, well, I would think, okay, we ran it and I would think like a forward-looking return assumption on that deal you're looking at is maybe this, and say like, is that good? I'm like, I don't know, like what's the alternatives? It's like, what's the alternatives? And are you getting compensated for the extra hassle you're taking? And sometimes that's like tough to quantify, but you just you have to look at things more completely, right? And not to talk my own book, but that's where good actual financial advisors help people think through those kind of things.
No, and I know you've helped my family and a lot of people like make those tough decisions, and you put a little bit of realism or like a little bit of a realistic piece into people's financial picture, which I think is helpful. One lesson that it usually takes people at least 1 or 2 rental properties to learn. Mm-hmm. And if I could save anyone some time, it's that even if you don't think you're in commercial real estate, if you're going to get a couple rental properties, you need to run it like commercial real estate and underwrite it like it's commercial real estate. Cause like you're saying, the days of buying and holding and just hoping it will appreciate, like interest rates are going to keep going up. It's looking like, right? Yeah. So I think I always tell people like, okay, like understand that whether you get into rental properties, self-storage, like apartments, whatever, RV resorts, like you need to think of scaling it or delegating that out and put that into your underwriting, or else it's really not a deal.
Yeah. My number one saying in real estate always is, if there's not room in the deal for a property manager, you're buying a job.
Yeah, it's true.
It's my number one fallback. And I think I want to just end on that. I think that's the most important thing for everyone to remember out there if they're looking to be investors. And jobs aren't bad, right? And there may be a time and season that you want to be an owner operator, right?
Yeah.
But just be honest with yourself on what the real net return is there. So Ben, I appreciate taking the time. If anyone wants to reach out, they got, more questions for you about, storage or your entrepreneurial journey. What's the best place for people to find you?
Easiest way, Instagram is Big Storage Ventures, or my personal Ben Gottfredson. That's the easiest way. Just slide me a DM and we'll hop on a call. Love chopping it up.
Cool.
Thanks for having me on, man.
Appreciate you. Thanks for taking the time. We will see everyone else out there.